Hello, my name is Tim McAvoy with the BJ Insurance Group, and today I want to address an issue that a lot of our clients have been asking us recently, and that issue is what's the difference between a variable and a fixed annuity? So most people, when they're approaching retirement or already are retired, they run into this concept because they talk to different brokers or people at the local bank on the corner, and they really get confused on which way to go with their retirement funds. So let me address some of the basic issues for you today. FIA is a fixed index annuity, and today we're going to put that up against a variable annuity. All annuities have different values. They don't really use the word principal. They'll use things like accumulation value and protected income value. So let me write those down here. So both fixed index annuities and variable annuities will have an accumulation value, which is like your lump sum or your purchasing power. And you also have a protected income value in most cases, not getting product or company specific. Now, accumulation value, again, is your lump sum. So for instance, if you had $100,000 in a fixed index annuity and the same in a variable annuity, most people think that if you cash out that annuity or you surrender your case, that that's how much you get. And your surrender value could be equal to that lump sum if there's no fees that are assessed on you and no penalties, which most people worry about. This is a little more tricky. Your protected income value is typically a rider attached to your annuity, whether it's variable or fixed, and those riders have a cost associated. Generally speaking, the fee for a rider is about 1 to 1.5%, and that's assessed annually on either annuity policy. What you get for that depends on the product you use and the company that you deal with. Some companies will guarantee you 4% a year, some 6% a year, some even 8% or 10% a year. But that is not on your lump sum value. This is on a systematic withdrawal. For instance, if you wanted to draw out 5% a year for the rest of your life, they would base that off of your protected income value with that guaranteed rider percentage. So let's take a look at how that works. Let's say the market goes up 5%. This would go up 5%, and this would go up 5%. The protected income value, if we assume that it's a 6% rider, that number would increase up to 106 in both cases. Now, if you push that out 5 years, this would look more like a guaranteed $130,000. So if you try to draw 5% of that the rest of your life, it would be considerably more than drawing off the initial $100,000 deposit. The main difference between a fixed annuity and a variable is what can happen if the market has a downturn. While the market's going up, depending on the funds and the indexes that your credit is based off of, both of these accounts can make you a considerable amount of money in retirement. However, if the market goes down, let's say it falls 10%, the fixed index annuity has principal protection and cannot lose your money. Once you make a dollar, that dollar becomes part of your principal or your accumulation value and cannot be lost back. It is insured fully. So even if the market takes a 10% downturn and you had $105,000, you just stay at $105,000. However, in a variable annuity, it's appropriately titled as variable because it can vary with the influx, ebb, and flow of the market. So if it falls down 10%, this also will lose 10%. And now, just for round numbers, if we say you fall to 95 grand, you're losing your purchasing power or your lump sum. For further questions, please go to our website at bjinsurance.net and you can contact us directly. Thanks for watching.